Yeah, it was the worst 20-year auction perhaps in history, from the way that I look at it. In fact, I think it is the only the second. Let me put it this way: it maybe the first or the second highest yield for a 20-year bond auction in history. There may have been one other. I read about it an hour or two ago, and it talked about it being over 5%. And I could have sworn it said it was the worst in history, if not the second. And, you know, you're witnessing, whether it be here or in Japan or in the UK or all around the world, the bond markets are in very big trouble. I think the concept of owning debt from an insolvent country, one that is irresponsible with their fiscal policy, even in the face of Doge, asking to raise the debt ceiling once again. This is emblematic of what we just saw just the other day, where the Fed had to come in and quietly, in what they call stealth mode, I guess, where they're not calling it QE, bought 43.6 billion worth of treasuries in 1 week, 20 billion in 3-year, 34.8 billion in 10-year, and 8.8 billion in 30-year. The Fed is coming in because no one wants to buy our treasuries at these levels, and you can see it here on the 20-year. That's probably why the market turned around and threw up the way that it did. And you can look at the Japanese market, same thing. You know, I think there is a certain segment of the Japanese population, forget about the unwinding of the Japanese carry trade. I mean, that's very detrimental in and of itself. We saw what happened a month or so ago when rates in Japan first started to move and everything calmed down, but here they are moving up again. And I think one of the reasons you're seeing gold catch a bid is partially because I think there are a lot of traders in Japan who figure the BOJ is going to have to turn around and go back to yield curve control, which should be very, very bullish for gold. But what you see happening here is an interesting phenomena. You know, the Fed is trapped between inflation and keeping rates down. I don't know how they'll do both, but you can see the market perhaps is even stronger than the Federal Reserve. And what's really interesting about all of this is that gold is moving up in the face of rising interest rates. Now, we're always told that rates go higher, gold goes lower, the inverse correlation between the two. But when you factor in what or who's issuing the debt, you know, I was listening to a Bill Fleckenstein interview, and he said, you know, on Wall Street, we used to call that a who-to problem. Who do we sell it to? And I think that's the issue, is that, you know, we're finding a pool of a diminishing pool of interested parties to buy our treasuries. And it's funny, you see China, who is now slid to number 3 in treasury holdings, replaced by the United Kingdom. Vince Lancy had a great analogy. He said it's like two drunk guys holding each other up from falling. You have, you know, the largest debtor nation buying debt or selling its debt to the second largest debtor nation, or real darn close to it anyway. So two broke nations buying each other's debt, as the rest of the world seems to be favoring things like commodities and cryptocurrencies or whatever the heck they can get their hands on that are tangible, copper or silver, gold or platinum, which we saw a microcosm of a short squeeze yesterday and a little bit today. And I think that's on a larger scale what you could expect to see in the silver market. But yeah, it's an interesting time right now. And certainly I think it focuses squarely on the bond market. That's where really the trouble lies. And the question being, you know, you raise the debt ceiling, you go around the world imposing tariffs that in many respects are actually sanctions masquerading as tariffs. You continue to spend irresponsibly. And the world at some point says, you know, we just don't want to purchase your debt anymore. And maybe that's kind of part and parcel what Zoltan Pozar was talking about, this move to Bretton Woods 3, a system that will move away from promises from an opaque debt system. And if you think about the concept of buying someone else's debt, another country's debt, and calling it an asset, it doesn't have a huge history compared to things like, tangible assets. And he said, that's where we're going, a system that will be transparent, like blockchain, and one that will be backed by commodities. And, the old saying, he who has the gold makes the rules. Well, that's exactly what President Trump said on Easter Sunday in a tweet, which is interesting. With the amount of gold coming into the COMEX, the largest deliveries in the history of the COMEX in the May contract, over 16,000 contracts, that's $5.3 billion worth of gold delivered in the May. That's over a 700% increase year over year from this time last year. But this is every single month we're seeing it, and it's not stopping. And I think you're seeing a lot of players that are choosing physical gold in your possession, which is outperforming the bond market as an alternative to it. It's not just here in the United States, it's everywhere, and even in places like Japan. So yeah, this is just beginning. We'll see how it all plays out. We've all lived under this belief that these types of issues will always be resolved and papered over, and they always have been, I guess, maybe until they're not. But right now, these are certainly interesting times. The LBMA uses a ton of unallocated gold accounts where you have several parties claiming the same amounts. That's what the Hunt brothers noticed in 1980. And it disconnects reality from paper. I mean, it's the reality is that there's many, many, many times more contracts than there are ounces to deliver. And I think this has been exposed. I often cite what the folks said with the BRICS Grain Exchange. We produce and consume more grain than the West does, but with the development but the price is controlled on COMEX, we can't control it. But with the development of the grain exchange, this will change. I think they understand it. The world understands it. That if there's not demand at these levels and the Fed has to come in to prop it up, to keep rates from blowing up. But if there isn't demand and you see auctions that haven't failed but have very lackluster demand, and who knows how much the Fed or shadow entities that represent the Fed in the Cayman Islands or whatever are bidding this stuff up, it will just become obvious at some point that that's the debt spiral, rising rates, and more money printing to buy the bonds to keep it down, and it just goes on and on and on and on. We're right there. So that's the point. That's why we're trapped. At some point, there's always a buyer for the debt at some rate, but there doesn't seem to be much appetite at these levels. So you're beginning to see rates start to move into levels that in months past have started to rattle the system, the banking system in particular. But if they do jump in, they've lost all credibility. And, Trump wants the rates lower. But remember, our dollar's lost 9% already. So how do you run a world reserve currency with all of this debt, with rates that are not commensurate with the falling of the dollar and the debt accumulation? No one wants to buy it, let alone the way that we behave with these countries, threatening them with sanctions and tariffs. They're finding alternatives. They truly are finding alternatives, and it's becoming very obvious to me. So yes, that is the playbook, come in and rescue the day. But if they do that, where's the credibility and where is the demand for treasuries when you look at a country that is resolved to never normalizing their balance sheet? And that's why people are saying that Japan's going to do the same thing right now. After all of these years of suppressing rates, the Japanese government owns 52% of the bond market. Well, where's their credibility? As rates go higher in an attempt to normalize their balance sheet and sell those treasuries into the market, they too have the who to problem. Who do they sell them to? Who wants them? Everyone else is gone. And we're beginning to witness a similar pattern here where the big buyers of our treasuries are moving in the other direction. And you take away the carry trade, rocket fuel, where people can borrow money in low-priced yen and then convert to dollars and buy Nvidia or Bitcoin or Apple or treasuries at that spread. Now that's disappearing very quickly. The unwinding of the carry trade can be just as viciously bearish as the ability to use the carry trade. So yeah, these are dangerous times for certain, and I think it all is going to be centered around the debt markets, which are far bigger than anything else, far bigger than the Federal Reserve has the ability to contain. And we can see that by them coming in and buying the 3, the 30, or the 3, the 10, and the 30, and the rates are still climbing even with that participation by the Fed. Yeah, I mean, well, you know, I did an interview with Rick the other day, Rick Rule, and he said only 18% of the silver that came to market, or 18% of the 850 million ounces last year that were available came from silver miners, and the rest was from recycling and from byproducts. So there is some recycling. I just don't know how much, and I don't know them to be flush with anything. I can tell you that because of the tariffs, getting non-denominated bars, non-currency denominated bars, I don't even know, what am I trying to say, non-monetary bars, are very difficult. The people importing them don't want to mess with it and risk the tariffs and risk trouble getting them in. So they're the ones that are making the bars. I don't know that to be true, to be honest with you. I had one of the biggest distributors in the world called me and asked me if I had any 100-ounce bars 10 days ago. And these are people that I typically buy from. So I don't know if that's true or not. I wouldn't really doubt that I wouldn't put it past it being true if you read it somewhere, but that's off my radar screen, and I don't know. I'm sorry.
Okay.